If you think reverse mortgages are a big scam, you couldn't be further from the truth. You're going to want to watch this video all the way to the end as we unpack what exactly reverse mortgages are. With me today is Tiffany Nyiri of the Active Lending Group to talk about reverse mortgages. And also, don't forget to subscribe and ring that bell so you don't miss any future videos. Hey, what's up everybody? My name's Dave Gove. I service the North Lake Tahoe and Truckee, California region, and I help buyers and sellers, investors and developers achieve their real estate goals. What can you tell me about reverse mortgages? I've got a lot of questions, but I want you to lay down some wisdom for me first, and then we can do a little Q&A later.
Yeah, reverse mortgages are traditionally for people over 62 years old. However, there are proprietary programs that go down to 55 years old. These loans can be used for reverse refinances, reverse purchasing. A lot of people don't know you can purchase a home using the reverse mortgage.
Yeah,
a lot of people.
How does that work?
I'm sorry?
I said, how does that work?
Yes. So reverse mortgages, if you have a loan, they pay off the loan on your house. This is a refinance. So reverse mortgages work opposite of what we call a forward mortgage. Most everybody that owns a house has a forward mortgage, and we're paying down the loan balance every time we make a payment. The reverse mortgage is opposite of that. Okay. So you're going to utilize whatever equity that you have in the home to live there without a house payment. No house payment. You have your taxes, you have your insurance, and you have an HOA if applicable.
Okay.
And these loans are used for strategic reasons as well as a necessity. A lot of our seniors these days, a lot of loans I'm doing are out of necessity, unfortunately, where my clients have all this equity, but they're not living their best life. They're living actually a life they do not enjoy at all. And when I can come to them and say, all right, well, let me alleviate you of your $1,200, $2,000 house payment, that will change their entire existence. They can now go to the grocery store and buy anything off the counter they want, not the little things that last a long time, like, beans and rice and noodles and those sort of things.
Cup ramen, like back in the college dorm days.
Again, this is real life. I just did one right here in my city, and our average sale price in our city is about $600,000, and these people were struggling. So anyway, that is just one avenue. But again, the reverse mortgage is a loan that has no house payment to it, just tax, insurance, and HOA if applicable. You've got to keep those up. A lot of people shy away from reverse mortgages because they think that, oh my gosh, the bank owns your house. Well,
That's what happens with a mortgage anyways, right?
Let me let you know on a little secret. Yeah, I'm gonna let you in on that little secret. They own your house anyway. So if you don't make your payment, they're going to send you a nice letter in bright pink paper and tell you to make your payment or pay your insurance or pay your taxes or pay your HOA. All of those things can trigger a letter from your investor. So there are a lot of myths about this. But what I was coming to you to talk about is a lot of scenarios that a lot of people don't know so that they can live their best life. And if you want to jump into that, I can jump into that right
absolutely.
now.
I mean, I guess I don't really, I kind of get the concept. Like, okay, you bought a house, you're 62 years old, and you've been in your house for 15, 20 years or whatever. You bought it for $245,000. It's worth $750 down in San Diego or whatever. But you still have that monthly payment that's, $1,000 from whenever you last refied it, or maybe it was the origination of the first loan that you had on it. So then you come to you and say, Tiffany, cash is tight. I can't sell my house because then I don't have anywhere to go. And my grandkids live around the corner. And, I just can't bear to be apart from them. And otherwise I'd move to Arkansas where I could buy a house for cash. But, can you help me out?
Yes, exactly. And there's a lot of different options that go along with that. They can do, they can do straight cash out, and they can get money to do repairs on the home. They can get money to help a family member buy a house. They can get money out as a line of credit that earns interest, not cost you interest, earns interest.
Wow.
Okay. And that is a major, major benefit to a lot of people that are, let's say, only 65. This line of credit is going to last you until you pass away, and it's going to grow. It's going to get better, not worse. It's going to earn interest. So let's say you're only 65 years old, you get a line of credit with a reverse mortgage, and at 75, you unfortunately have some medical issues, and we need to kind of rehab the house a little bit so you can get around better in it. You might need to expand your bathroom, you might need to expand your hallways, that sort of thing. Well, that line of credit is sitting there for that reason. Just hanging out, waiting for you to need it. Or maybe you need in-home care and Medi-Cal is not going to pay you. And you only want someone 3 days a week and you're going to have to pay cash and you're on fixed income. Like, that just doesn't work. That calculation doesn't work with your income. So every month you can pull your $1,000 that you need because you've just accumulated $300,000 in a line of credit, and you can just
and that's the equity in the house, right?
That is a portion, a very small portion. The algorithm for allowing you to take money out of your home on the reverse mortgage is very tight. They do not let you take a bunch of money. It's based upon your age and how much equity you have, and of course how much longer you have to live to get to 100. Their algorithm is very similar to life insurance. Okay. Unfortunately, their algorithm takes into consideration dying.
Well, there's no getting out of it for any one of us. So I mean, it's
there's no getting
fact. Out. So yeah, it seems like that doesn't seem unreasonable that they'd factor that in. Yeah.
Yeah. So one of the scenarios that I was going to bring to the table with you today is this gal, Northern California. Her husband was sick for quite some time, and he passed away. And she's wondering to herself, why on earth am I living up here? We were only living here for his job. So her daughter lives in San Diego, but she can't afford San Diego. But she really wants to live down near her daughter. So we start to talk to her, and we're getting all this information. And why not live your best life? So we're putting this reverse mortgage in front of her and her daughter, because of course we like to bring the adult children into the conversation and discuss the pros and cons. Well, there were no cons for this lady. It was all boom, 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 great deal. Because what we did is she sold her house with $500,000 of equity. Okay. We only needed $400,000 for her age to buy an $800,000 condo in San Diego. That means we had $100,000 left over to put back into her retirement account to start making her more money, because she's one income now, and they depleted their funds just because they were paying a lot of medical bills. Sure. Yeah. And now she is again living her best life in San Diego, near her kids, near her grandkids, and in the cutest little condo. And she's paying her taxes, insurance, and HOA. Okay, so we had a house. We had $500 cash that came out of the proceeds from that transaction. We put 50% of that down on 50% down. That's $400 on that $800,000 condo. And then she takes that $100K, puts it back into an investment tool of her choice, right? Of her choice. Okay, great. And then she's responsible for HOA, insurance, property taxes. Only. As if you paid cash for the home. As if you paid. So who is paying for that other $400,000 worth of credit on that house? Your equity. So your equity, that $400,000 difference. Gotcha. Yep. Is your equity, and they're using it every single month as a payment. Okay. Okay. So your loan balance is going backwards than you would normally have in a forward mortgage. Yeah. So what I do is I show the client the amortization schedule, and we look at their age. We look at how much they're borrowing. We look at the loan amount. Obviously will get bigger in time. It will grow. But we also have to take into consideration that specifically in California, our appreciation is pretty darn good on average. Pretty consistent. Without taking the COVID appreciation into consideration the last 2 years, our general appreciation is 6.5%. Yeah. When you do a reverse mortgage, the amortization chart automatically gives you 4% appreciation for California, which is very conservative.
Yep.
So you're building that appreciation because you're still owning your house.
Yeah.
And you're still earning that appreciation, even though they're pulling a little bit every single month. It evens out a little bit depending on the interest rate.
Yeah, and let's say, so in this scenario, we have an $800,000 condo.
Yeah.
That's going to be appreciating approximately 6% annually, right? So if she owns it for another 10 years, that's going to grow. This gal in this condo, let's say she's now transitioning later in life and having to move into a facility where she can get some more care, and it's time to liquidate this asset. What happens?
Good question. So all of these are owner-occupied loans, so you do have to stay in the house. If the borrower leaves the home, the loan is now due and payable just like any other home would be if you were owner-occupied, and well, you can rent out your home after a while, but these are all owner-occupied. So when they move out, the heirs or that person, if they're still able to pay their own bills and things like that, then they initiate the sell themselves. Otherwise, the people taking care of them initiate a sell, or it can be refinanced into another family member's name and just pay off what is owed. Just or like a normal loan.
Conventional too, right?
Again, there should be equity. If there's equity, you can sell, you can refinance.
Got it. Okay.
Just like an
owner occupied. So you can't get this loan and then rent your house out for $10,000 a month and go live on a yacht.
Owner occupied is considered 6 months and 1 day.
Ooh, okay. So that's interesting. Especially for those of us that are in snow country that eventually want to live in the desert half the time.
Well, that gets us to option number 2.
Let's take a look.
So we had this family member, they were just retired and they're adjusting to their new income. Okay. But their friends, in fact, this is the story I tell because I love the Tahoe area. So their friends just bought a cute little condo on the lake in Tahoe. And these people really wanted to go where their friends were living. They're like, oh man, if we could live in Tahoe, that'd be awesome. North side, of course, north side.
Yeah, of course. Whole different world.
They don't gamble. They don't gamble.
No offense down there in South Lake Tahoe, but yeah, it's a little. I had a buyer recently she put it really well. She was looking at Truckee and North Lake Tahoe and South Lake Tahoe, and she goes, yeah, we spent some time in South Lake Tahoe, and it's well, it's a little more gritty down there. I was like, that's the perfect.
I liked it for the afternoon and the evening, but then I'm like, oh, let's go back to like little retirement community on the north side. So these people, fortunately, had been doing very well with their equity when they bought. They paid extra. They have $500,000 in equity. Cool, because using this algorithm, not everybody is going to be the same. Okay. You cannot always just put 50% down, but for the purpose of our conversation, we're using 50%.
Okay. So can you do less than 50%?
Most likely never, unless you're like 90 years old. Okay. Again, algorithm.
Yeah, I got you. Okay. All right. So that's a key factor really to know that you've got to have that 50% equity. Got it.
If you're only about 62, 65, you're going to be putting much more down than 50%.
Yeah.
Especially in today's environment. Okay. Because again, we need to be conservative.
Okay.
So $500,000 got them $1 million lake home that they are owner occupying.
Awesome.
Okay. They have taxes, insurance, and HOA, and they are happy. Yeah. Happy. Kids come up, hang out, and have a great time. And of course, they're being right by their best friends who, golly, I can't even imagine retiring.
And so if they wanted to, 6 months and 1 day, a lot of people up here, you're probably familiar with ski leases, where people will lease out a furnished property from about December 1st to about April 15th or thereabouts. And then people then use that property to come up and go skiing whenever they want. So they could then be getting that monthly payment from the reverse mortgage, right?
No, they should not be renting out the house.
Oh,
The idea
yeah,
behind
you
it
have
is,
guests come then.
say if you wanted to be in Palm Springs for the winter, you're not a skier, you don't want to be there for the winter.
That's what I'm talking about. Yeah.
That house needs to stay vacant.
Aha.
Okay? Because you are not there. A family member most likely could stay there, but you should not be collecting rent.
Got it.
Because it is not an investment property. It is not an Airbnb.
Got it. Okay.
Okay.
Fine print.
Yes. So you want to go on to option number 3?
Yeah, let's take a look.
Okay. Option number 3, you're not going to come across very often.
Yeah,
but
who gets divorced after 62? I mean, it's like you've made it this far. Like what, you know?
Be surprised.
Okay.
Be surprised because they are still fit and active and they want to get out there and do their own thing.
Yeah. All right.
So they're going to sell the big house that they raised the kids in. They're going to get $800,000 of equity. $800,000 total, $400 each. And now they can turn around and go buy in the exact same neighborhood if they felt like it. So their church doesn't change, their friends don't change. They can stay in the life they are accustomed to.
Nice.
And not have a payment because they didn't have a payment before and they would prefer not to have a payment now.
Okay.
So that is, again, the 50% example.
Got it.
This other one you might run into, I know we run into it a lot here. You have this house and a lot of people want to pay their house down and give the house to the kids. Okay. A lot of kids don't want that house. A lot of kids want money to go do whatever they want with it.
Sure.
I hope they're not buying Escalades, but we really, really want them to buy a property. Okay. So this particular client, mom and dad lived in the house. The kids lived in the house with them, and they had the grandkids in the house.
Holy smokes.
And it's, again, traditional. It happens a lot where I live, actually. Mom and dad feel obligated because the whole family is under one roof and this is the family house. However, mom would just really love to be Susan. She doesn't want to be mom and grandma every day, all day. Okay.
It's like, get the heck out of here. I'm done.
She does not want to host Sunday dinners anymore. She doesn't want to do any of that. She wants to pass the torch.
Yeah.
And so we talk to her and we say, okay, you guys got $500,000 in equity in this home. And you want to stay in the area. Okay. Well, they went and bought a little condo for $600,000. They put 3 down. Again, 50% rule. And they gave $200,000 to their kids in future inheritance. So they did not wait for the kids to get this money after they leave this beautiful earth. They just said, why don't we take some of this equity now? Let our kids go buy a house and start building their family in their own home.
Yeah.
My daughter-in-law can go and make Sunday dinners for me now. Susan's so happy. Like,
That's great.
so happy. And the kids are very happy because now they have their own house to raise their children in.
Got it.
And so this is a way to make everyone happy before you leave this beautiful earth. There is no reason that you should have $500,000 in equity and not be living your best life.
Sitting there and not be able to capitalize off of it.
No one's living their best life right now because the house has got all of this equity tied up and no one knows what to do with it because no one really wants this house payment. No one has the extra money to fix the house.
Right.
It's in disrepair. This is beautiful.
What happens? I'm sorry to do this to you, Susan, but you know it's going to happen. What happens when Susan crosses the Rainbow Bridge, and who's left to pick up the pieces and liquidate the property? I mean, is anything the kids beholden to do any of that, or how does that work?
Well, we always like everybody to have a trust because we don't want to go to probate. No probate, because probate takes too long.
Yep.
And the reverse mortgage servicer is going to want something done within 90 days.
Yep.
Well, you can't get probate done in 90 days.
Right.
Even with a forward mortgage, you would go to probate if you didn't have any heirs attached to your home.
Hey, just in case some of our viewers don't know, let's talk about real quick what probate is.
Probate is when you do not have a trust or someone that is still alive on title. Okay, that means if no one's on title that is still alive, or you don't have a trust, the state decides who should get your home. And it costs your heirs quite a bit of money to deal with probate court.
And grief.
Yes. They're dealing with you passing. And then, of course, they have this house that the courts are like, hey, you know, we're going to tell you what to do with your own house now.
Yeah. Okay. So everybody get a trust. All right. So
your next interview is going to be with a trust attorney.
All right. Sounds good.
Yeah.
Okay. I like it. Okay, great. So Susan had a trust, and the trust then has clear directions on how this house is going to be disposed of and who's going to be in charge of doing that.
Yes.
And then you've got 90 days from Susan's passing. Rest in peace, Susan. And then there's a couple choices. They can liquidate the property on the open market and right, and then just pay back. Okay, so what happens? Let's say that's the route that they're going to take, and this house is now worth $1.2 million. And how does the lender get all of that equity, or is there any equity share that goes back to the kids, or how does that work?
Okay, well let's play the scenario out where the home has equity. Okay, you would sell it or refinance it just like any other home. The heirs have an opportunity to buy it. I think it's still 5%. Each person might be a little bit different in their guidelines. 5% under market.
Yeah.
Okay. So that's kind of cool if you do want the house, and the kids can qualify for a traditional loan on that home. The reverse mortgage has to be paid off.
Got it. And there's a loan balance on there for the reverse mortgage. Let's say the loan balance is $800,000. They can sell the house for $1 million. After closing costs and whatever, there's $120,000 left over, and they pay off that reverse mortgage and do whatever with the cash.
Just like a traditional home.
Now
let's go the opposite way, and let's say that this house is over encumbered because Susan lived a very, very long time.
Susan, longevity.
I know. She's good because, again, she's not cooking on Sundays anymore, so she's
frees up her time for yoga classes and breathing exercises and juice cleanses.
So, let's say it's worth $1 million. And Susan lived so long that her loan balance is $1.2 million.
Eesh.
So she used $200,000 of the bank's money, living her best life.
Okay.
Susan was super happy. She didn't mind.
That's it. I mean, it's just like, that's it. The bank lost $200K.
Yep. And that's it. The kids do not get the home. It's over encumbered.
Sure.
But mom lived her best life.
Yeah. Crushing it. All right.
Yes. So that is what a lot of people they make their myths about. Oh my gosh, the bank took my house. Well, not really. You just used $200,000 of free money.
Yeah. Okay. Awesome. What's the underwriting process like?
The underwriting is actually very simple. They don't have qualifications like a traditional loan would. There's no ratios. Credit does not have to be perfect. They look at it as a whole. They do a couple interior guideline checks. They do look at credit. They do look at debts. They make sure that you can pay your taxes and your insurance.
Mm-hmm.
If your credit is a little bit below what they'd like to see, sometimes they make you have an account with your taxes and insurance already put away for the next 10 years.
Okay. And is that like an escrow account, or
it is like an escrow account? Yes. Yep. And it's pretty hefty. So, the one that we were doing, they wanted to impound $40,000 of his money for taxes. And fortunately, he didn't want that. So I just worked with the underwriter a little bit, and we did not have to do that. But now he got $30,000 in his pocket instead, which is what he needed because repairs were needed on the home.
Yeah. Okay.
So we have an opportunity to talk to the underwriter.
Okay. And then what about timeline for approvals, clear to close, all that stuff?
Okay. So different things. So if we're doing a refinance, that's fairly simple.
Okay.
30 days. And only because a lot of times we're dealing with seniors, and a lot of them just come into my office and they drop off documentation, or they're putting them in the mail. So some of
Gotcha.
mine have scanners at home and some don't.
What DocuSign?
We have gone through and did a little teaching seminar on how to scan with your iPhone.
Oh, I
So
love
a
it.
lot of my seniors are very techie now.
Nice. Good. Okay.
But 30 days. But if you're doing a purchase, I would highly suggest a 45-day escrow if you could at all do it.
Okay.
And there's two things that you have to be aware of when you're doing a purchase. Number one, escrow company has got to know how to do a reverse mortgage, and they've got to have the software to produce old school HUDs.
Okay.
Okay. Number two, there could possibly be two appraisals. And those are the really only the two things that we absolutely need to pay attention to and that both parties need to know about.
Okay, great.
That's
Okay,
it.
perfect. All right, and I see we've got your contact information right there on the screen.
Oh, yeah.
Okay, awesome. So if anybody out there wants to know more about reverse mortgages, you can reach out to Tiffany directly. And if you want to know anything about Lake Tahoe and Truckee real estate, you can reach out to me directly. And don't forget to hit that subscribe button and ring that bell so you don't miss any more informative videos.